In this video, we will discuss the differences between two costing methods, absorption and variable costing. But first, I want to remind you of the three product costs: direct materials, direct labor, and factory overhead. Direct materials and direct labor are both variable costs. These costs increase when more units are produced. Overhead is a bit trickier, as it can actually be split into two parts. Some overhead costs are variable, such as electricity. When more units are produced, there are higher electricity costs. Other overhead costs are fixed, like factory rent. Even when more units are produced, rent costs don't change. If we look at it this way, we really have four product costs instead of three. We have direct materials, direct labor, variable overhead, and fixed overhead. Let's just call these costs instead of product costs for now, as not all costing methods consider these four costs to be product costs. The method of cost determination that includes all four of these costs as product costs is called absorption costing. Absorption costing is required for financial reporting, so any public financial statements that you see will reflect the absorption costing method. But there is a different type of costing that only considers the variable costs of direct materials, direct labor, and variable overhead. We call this costing method variable costing. The fixed overhead is considered a period cost under variable costing and will not be counted in the cost of inventory or cost of goods sold. This method cannot be used for financial reporting purposes, but might be useful to make managerial decisions. Now, an extremely important thing to mention is how product and period costs differ in terms of when they get reported on an income statement. Product costs are expensed in the period they are sold through the cost of goods sold. Period costs are expensed in the period the expense is incurred. Depending on if absorption or variable costing is used, the fixed overhead could be counted as either a product or a period cost. This creates income discrepancies between absorption and variable costing. To simplify things a little bit, in this video we will only be considering the situation where production units and costs are the same in each period. If we have that assumption, then there are three possible scenarios. If the number of units produced is equal to the number of units sold, the net income is the same under the two methods. This will be true even without our assumption. If the number of units produced is greater than the number of units sold, net income under absorption costing is greater than the net income under variable costing. If the number of units produced is less than the number of units sold, net income under variable costing is greater than the net income under absorption costing. We will see why these rules work when we look at our example problem, but know that it has to do with the expense cost of goods sold, which is only recorded when units are sold. Since absorption costing includes an additional cost in cost of goods sold, the fixed overhead, when more units are sold, absorption costing income will be lower. So now let's look at an example. We will be comparing the income statements for absorption costing and variable costing for 3 consecutive years. Here is a table showing the number of units produced and sold for the 3 years. As I mentioned a moment ago, we are going to let the units produced each year stay constant to simplify the example. Here is a table with additional information which includes the selling price per unit as well as the production and period costs. With this table, we can calculate the product cost per unit for both absorption and variable costing. As we discussed earlier, the direct materials, direct labor, and variable overhead are all classified as product costs for either absorption or variable costing, so we can simply copy over the values from the additional information table. The direct materials are $10 per unit, the direct labor is $15 per unit, and the variable overhead is $6 per unit. The fixed overhead is not a product cost under variable costing, so we can leave this cell blank or use a dash to signify fixed costs are not product costs for variable costing. For absorption costing, we can calculate the fixed overhead per unit by taking the total fixed overhead costs per year, which are $200,000, and dividing by the number of units produced in that year, which is 40,000 units. 200,000 divided by 40,000 equals 5, so the fixed overhead is $5 per unit for absorption costing. Adding up the product costs gives us $36 per unit for absorption costing and $31 per unit for variable costing. Let's move to the income statement comparison in 2019 when the number of units produced are equal to the number of units sold. Both are 40,000. Here is the format for the income statement we will prepare for absorption costing. We begin with the sales, which are equal to the $50 selling price multiplied by the 40,000 units sold, which comes to $2 million. The cost of goods sold is the product cost per unit of $36 multiplied by the 40,000 units sold, which equals $1,440,000. The gross margin is the sales minus the cost of goods sold, which comes to $560,000. Then we must subtract the selling and administrative expenses. We have $100,000 of fixed selling and administrative expenses, but we also have $8 of variable selling and administrative expenses for each unit sold. So the total selling and administrative expense is equal to $100,000 plus $8 times the 40,000 units sold, which simplifies to $100,000 plus $320,000 or $420,000. The net income is the gross margin minus the selling and administrative expenses, which comes to $140,000. Next, we can move to the income statement using variable costing. Variable costing lends itself to the contribution margin style of income statement, so that's what we will be using. We begin with sales, which are still $2 million. That hasn't changed. Then, instead of cost of goods sold, we will list the variable expenses, to which there are two, the variable production costs and the variable selling and administrative expenses. The variable production costs are $31 per unit, which we calculated earlier, times the 40,000 units sold, which comes to $1,240,000. The variable selling and administrative expenses are $8 per unit multiplied by the 40,000 units sold, which equals $320,000. The total variable expenses are $1,240,000 plus $320,000, which equals $1,560,000. Taking the sales and subtracting the variable expenses, we get a contribution margin of $440,000. Next, we can move on to the fixed expenses. The fixed overhead is listed as $200,000, and the fixed selling and administrative expenses are listed as $100,000. Adding them together gives us the total fixed expenses, which are equal to $300,000. If we subtract the total fixed expenses of $300,000 from the contribution margin of $440,000, we get $140,000 in net income, the same number we got using absorption costing. So now we have finished the two income statements when the number of units produced is equal to the number of units sold. Now let's move on to the next year where the number of units produced is more than the number of units sold. Now we have 40,000 units produced and only 30,000 sold. All the calculations on the income statement will use the 30,000 units sold. We already considered the 40,000 units produced when we calculated the product costs earlier. For absorption costing, we begin with the sales, which are equal to the $50 selling price, multiplied by the 30,000 units sold, which comes to $1,500,000. The cost of goods sold is the product cost per unit of $36, multiplied by the 30,000 units sold, which equals $1,080,000. Make sure you multiply by the number of units sold and not the number of units produced for the cost of goods sold. The gross margin is the sales minus the cost of goods sold, which comes to $420,000. Then we must subtract the selling and administrative expenses. We have $100,000 of fixed selling and administrative expenses, but we also have $8 of variable selling and administrative expenses for each unit sold. So the total selling and administrative expenses is equal to $100,000 plus $8 times the 30,000 units sold, which simplifies to $100,000 plus $240,000 or $340,000. The net income is the gross margin minus the selling and administrative expenses, which comes to $80,000. Next, we can move on to the income statement using variable costing. The sales are the same at $1,500,000. The variable production costs are $31 per unit times the 30,000 units sold, which comes to $930,000. The variable selling and administrative expenses are $8 per unit multiplied by the 30,000 units sold, which is equal to $240,000. The total variable expenses are $930,000 plus $240,000, which equals $1,170,000. Taking the sales and subtracting the variable expenses, we get a contribution margin of $330,000. Next, we can move on to the fixed expenses, which are exactly the same as they were in the last year, and total to $300,000. If we subtract the total fixed expenses of $300,000 from the contribution margin of $330,000, we get $30,000 in net income. This time, we can see that there is a difference in the net income between the two methods. Absorption costing has a $80,000 net income, and variable costing only has a $30,000 net income. Once we complete the income statements for 2021, we will discuss how to convert net income from absorption to variable costing and vice versa. Okay, we have one more year to complete income statements for, which is for 2021. This time the number of units produced is 40,000, which is less than the 50,000 units sold. You've had the opportunity of watching me complete these income statements twice now, so now it's your turn. Pause the video and see if you can complete both of these income statements. Also, try to guess which costing method will result in higher net income this year, and by how much. Okay, we are back with the answers. Feel free to pause the video to see if your numbers match mine. The net income is $200,000 under absorption costing and $250,000 under variable costing. The absorption costing income is lower this time because the company is selling more units than it's producing. Fixed overhead costs are expensed when the corresponding units are sold under absorption costing, rather than when incurred, as is the case under variable costing, causing us to have more expenses and therefore lower income under absorption costing. We are so close to done. There's just one last thing I want to talk about, and that's how to convert from variable costing net income to absorption costing net income and vice versa. It's extremely important to note that these formulas only work if the product cost per unit is the same each period, which often isn't the case when production units change from period to period. Here are the formulas. You can find the variable costing net income by taking the absorption costing net income and adding the fixed overhead per unit times the number of units sold minus the number of units produced. You can find the absorption costing net income by taking the variable costing net income and subtracting the fixed overhead per unit times the number of units sold minus the number of units produced. Let's apply this to the 2021 income. For absorption costing, the net income was $200,000, and for variable costing, the net income was $250,000. There were 50,000 units sold and 40,000 units produced, and the fixed overhead cost per unit were $5. Using the absorption costing income to find the variable costing income, we have $200,000 plus 5 times 50,000 minus 40,000, which simplifies to $200,000 plus 5 times 10,000, which is equal to $250,000, matching the variable costing income. Using the variable costing income to find the absorption costing income, we have $250,000 minus 5 times 50,000 minus 40,000, which simplifies to $250,000 minus 5 times 10,000, which is equal to $200,000, matching the absorption costing income. If all you want is the difference in net income from the two methods, you can take the fixed overhead cost per unit and multiply by the difference between the units sold and the units produced. In our example, that would be 5 times 10,000, which equals $50,000. Alright, that wraps up everything I wanted to talk about relating to variable and absorption costing.